here we are on this pre-Valentine's Day episode of Freightonomics. Not a ton of love sitting out there in the market in February, economically or freight market-wise, but it's somewhat expected. I'm Zach Strickland, head of Freight Market Intelligence. Tony Mulvey, senior analyst.
Yeah. I think your field of love comment, it echoes what my the pricing power index for this week, the truckload market's failing to field the love in February.
Yeah, February. We had a relatively responsive January.
Yeah.
And I think, and then we've had all this noise with the tariffs and geopolitical stuff that's really kind of fueled a lot of uncertainty in the market. We covered that a few weeks ago. Of course, we were out last week, some technical difficulties, but we're back.
We are. It feels like we were just here talking about this, but
I know.
Last week was going to be a fun show because you got pauses and tariffs.
Yeah.
And so we're going to touch on that today.
We'll cover the things we missed in light.
But we've got to set the stage on the market and where we are in the truckload market. And no better way to do that than with a market in two. So Zach, if you're ready, we'll get going in 3, 2, 1.
Let's kick things off with the outbound tender rejection index, and we are looking at a steep decline to start the month of February. I think this is probably alarming to several people. Now, again, the steep decline is from somewhere around that 6-ish% range down to the 5% range. We're still executing above last year's values. That is the big takeaway here, is that we're not seeing a retraction or a snapback moment. This is some seasonality showing up in the market. Like the last 2 years, we had some winter weather situations that kept rejection rates elevated. That's not Christmas that you're looking at there to start the year with that big spike. That is literally a couple of winter storms that hit the market and kept these tender rejection rates elevated. And market imbalance is really what drives a lot of these situations, not necessarily a straight removal of capacity. So let's go to the next chart, look at the spot rates. Spot rates, of course, also seasonally in decline. This is the last year. So that little spike you see in January, that's winter weather. We've been coming back down. This should have happened to start the year. If we didn't have the winter weather, spot rates and rejection rates would have both fallen down like you see here today. A little bit of a bounce here. This is some volatility showing up. And I think this is going to be the situation moving forward. We're going to see some pretty dramatic downswings, but also it's going to have some more responsiveness throughout the rest of the year. Let's look at demand with the next chart, outbound tender volume index, which is, of course, measuring total tenders that are being submitted. Demand is not causing any disruptions. We're seeing this downward swing in demand here over the last couple of weeks. This is, of course, driven by an offset. Intermodal is taking a lot of this share still. The total demand figures, if you're looking at this from an economic perspective, are still on par with last year. We've got tariff pull forwards and things going on there that are helping keep demand elevated. However, it is not all going into the truckload market. Let's finish things up with a heat map of spot rates in the United States. Anything in blue is going up, anything in red going down, and you can see most of the market.
Yeah, down. I think it's interesting. It's a very different look than what we would have had this time last week. I think some of that is last week you had reactions to some degree to tariffs, even though they were paused. I mean, those border markets, El Paso, Laredo, were higher last week than they were this week. And I think you're seeing the markets taking the pause, and now it's reacting how you would expect.
This is February.
Halfway through February.
Yeah, this is February activity. We've got some percolation around the border markets in Texas. Texas has been active, like you said, the last 2 weeks.
Yeah.
Laredo specifically showing up last week. But we've also had Houston and San Antonio showing up strangely here. So it's a little bit nuanced. There's a few spots around the mid-Atlantic and Northeast. Could be some winter weather influence there. I don't know how significant these storms actually are in terms of transportation, in terms of aggregate. Obviously, they're very impactful at a local level, especially the ice situation there. But nothing strong enough to overtake, any kind of seasonal trend in the market.
Yeah, I think that's the key theme right now is like seasonality is reigning supreme versus any other disruptions. I don't think it's a surprise. I mean, like you said, we would have felt it earlier. I mean, all it did was push it from January into February. I mean, if you look at the spot rate chart, I mean, we had the winter weather last year at the end of January. The charts almost are identical. We're just at a higher level, which is
The
mean,
shapes are similar, but
The
the magnitudes are
different.
much bigger.
Yeah, which is not a bad thing. I think if you're in the market, like you want to, that's what you've been looking for.
Yeah.
That's more volatility, and more volatility means, in most cases, especially where we're at coming out of the freight recession and into this like next cycle, like you want the volatility because that thing, typically it's going to be to the upside, not the downside in this situation. So versus when we came off of COVID, there was increased volatility, but it was to the downside, not the upside. So I think that's
we're going the other way now.
Yeah, which is the positive sign for the market.
I wanted to call out a little nuance in the market that I find super interesting. So the Freightonomics viewers get a little bit of a taste here. So we've got this trade imbalance situation going on. We've got a lot of pull forward activity from tariffs. We got containers still flooding the Los Angeles market. So I wanted to pull up the chart of the outbound tender volume index for Chicago and Ontario. And you can see here, Ontario outbound tender volume index is in white. It's got a pretty strong growth signal at a 7% year over year versus this time last year. Pretty strong upward trend. We've come down off of the seasonal highs that we normally see. January is not Southern California's time of the year traditionally, but from a seasonal perspective, we're growing. And we're above where we were this time last year. You look at Chicago. Where does all the intermodal freight go and get off?
Chicago or Dallas?
Off in Chicago, Dallas, and to some extent New Jersey. But it is declining in overall volume. 11% decline year over year out of Chicago. Now, here's the fun thing to look at. If we pull up the next chart, which is the rejections for both of these markets, guess what? They're the opposite of what you would expect.
Yeah.
Ontario rejection rates under 3%. Very, very low. That is deflationary territory. Chicago rejection rates above 7%.
Yeah.
Demand is not driving this. This is a straight up revenue, operational network maneuver by carriers to cover that Los Angeles freight more than Chicago. They are balancing their networks towards the West Coast because there's bigger utilization numbers there. Average length of haul out of Ontario, 900 miles. Average length of haul out of Chicago, 500 miles.
Yeah.
So there's utilization, and there's also, we've already had pricing pressure in Los Angeles. Contract rates have increased there faster than they have out of Chicago.
Yeah.
And therefore, carriers are financially inclined to go cover this freight.
And what's it do? It leaves markets like Chicago exposed because, I think you've touched on it. It's the carriers, when they know freight's coming out of LA, it's what, 4 days or so for that capacity to get back to the market?
Yep.
There's not a lot of freight that flows Chicago to, there is, but relative to the vice versa, the freight flows from Chicago to LA or Ontario far less than outbound. So it leaves markets like, when there's a lot of freight in markets like Ontario, it leaves other pockets of the country exposed. That's what you want to see to signal that a market is changing, is these pockets of disruption from solely the capacity front in this situation, because any demand side change, right? If Chicago starts to see growth and now that market is exposed, it kind of exposes the entire U.S. network to some degree.
Yep.
And that's where pricing, it's not, everybody talks about demand side as what drives freight market shifts. It's true, but there is another side of the market that often gets misrepresented, and it's the supply side. When you have enough leave and you don't feel, you won't feel it if demand is stable or growing slightly, won't happen, but then you get the demand side catalyst. That is the second part that happens in this equation, not the first part.
That's the thing that waterfalls out into the rest of the market. We're not quite there yet, but we are starting to see these little nuances, these market percolations. We talked about them last year showing up more. They are showing up more frequently. This is February too. So this is not the time of year that we normally see this type of activity. So I want to talk about inflation for a minute here before we get to some of the top stories of the last couple of weeks, of course, centering around tariffs, but inflation continues to be a concern.
Well, it's trending higher.
Yeah.
You look at this chart, everything that we've been talking about where you've made improvements in inflation, it's really halted. You're starting to trend higher. So here, year over year changes in the consumer price index, just this time versus last year, up 3%. I mean, we got down into the mid twos into last year, call it August, September of last year, and we've been on the rise since.
Yeah.
And that is the concern moving forward, is everything the Fed has done to lower interest rates has a lagging impact on the market. But they are taking data that is happening kind of on a monthly basis, right? This comes out monthly, and they don't use it. Right. I mean, this particular, they have other subsets of data that they prefer, but I think to me, it shows, you look at the labor market, it's healthy. Unemployment's 4%. You could even touch on the U6, which factors in far more nuance.
Right.
But it's been declining and flattened out. I mean, it's down off its peak. So to me, it's a sign. Labor market's fairly healthy. We can talk about where job growth comes from and the nuances without that. That could be a whole show in and of itself. But on the surface, labor market's healthy. You have inflation that's still running above the target. I mean, if you look at the CPI and exclude energy and food prices, it's 3.3%. That's higher than it was. That's higher than the 2% target. All that to say is the Fed is not going to cut interest rates anytime soon. There's no reason for them to. And I think that is one, from a demand side, it's like, well, you're not getting what you expected. So maybe there's some slow, especially on the industrial side.
The good news here, if you can read good news into this inflation, is that the reason prices increase because people are willing to pay them.
Well, yeah, I think that's especially at the grocery store. And it's not a factor of prices are going up. I mean, input prices are going up.
But companies are largely they're increasing rates because that's what the market says they can. And again, I'm not trying to say that it's good for the economy that we see.
No,
grow. It's that there is a positive signal here in the way that people have the money to spend. But you kind of want to remove the necessities out of this, the staples. The eggs, of course, are getting a lot of the headlines because of the bird flu. But it's, some level of this is that people have the money to spend on certain things.
Wages are outpacing inflation growth.
Yeah.
That's just a positive sign overall. I mean, to some degree, right? I mean, they were up basically 4% and inflation's up 3%. In that range, they are going to raise prices to an extent. Inflation doesn't go away, even in a healthy economy. It's the most healthy economy.
They target 2 to 3% in general because inflation is healthy on that level.
Yeah, you don't want to have deflation because that is when things become a problem, right? They call it disinflation, where the rate of prices slows down. Well, it's not at this moment, and I think that's a thing to pay attention to. But I mean, your wages are growing faster. You're going to still see inflation. The challenge is it's so different than any market. Everything falls to the margin, and the marginal consumer is the one that feels inflation the most.
Right.
And I think that's the challenge, is like, from the marginal consumer, things are more challenging than they were.
Sure.
So your higher income earner, it doesn't affect them. The lower income earner, they've traded down to some degree, and maybe that's not where you're seeing the inflation. It's that margin, that kind of in the middle consumer ultimately it's the middle class consumer that drives the economy. Again, that marginal consumer, they're the ones that feel the brunt of these things.
Yeah. So speaking of inflation, we've got a lot of economic policy, tariff. The new administration, of course, threatened pausing tariffs over the last 2 weeks. There's still the ongoing concern about tariff implementation, what that means not just for Mexico and Canada, two of our largest trading partners, but everyone else in the world, as this is apparently the opening salvo of what is going to be an ongoing thing. Now, in that, we had the de minimis, which was repealed and then paused. There's so much kind of struggle to get a grip on what all of this means. And some of it's, obviously uncertainty is inflationary unto itself, because then you are stagnating your ability to make a decision. And so it keeps you in this world of, well, I've got to spend money right now that I probably wouldn't to make it more efficient.
Yeah, it's one of those things. It's actually interesting. I mean, the dynamics of tariffs in themselves, implemented by themselves, are inflationary. That makes sense, right? The cost to move it it's inflationary by itself. The argument is that you have to lower interest rates at the same time you implement tariffs. Well, the Fed has basically come out and said they're not moving interest rates. So if you go implement tariffs, it's going to be inflationary.
Yep.
What does inflationary pressure do to the Fed's decision making? It makes them raise interest rates. It moves counterintuitive to like what you're trying to accomplish.
Right.
And I think that's an interesting dynamic that's going to.
Yeah, we've had this political and legislative push and pull with the Fed over the last several
Who's
years.
supposed to be apolitical.
Yeah, and it's very well. They're coming from it from a monetary policy standpoint, and of course the executive and legislative branches are coming at it from a political. I want to get the votes and make my people happy standpoint, and those have conflicting interests at times. Now this de minimis situation, Mike Bowden-Distel actually writes this article this week, which I think is phenomenal about ocean rates, not necessarily the air cargo one that we have pulled up, but will ocean rates collapse? And of course, Mike Bowden-Distel, market expert on our squad, covers the CPG. He has his own show called The Stock Out. If you're interested in CPG and all things that nature, absolutely you should watch this. Well, he tackles ocean rates. Will ocean rates collapse this year? And he also, in that, talks about the de minimis repeal and pausing. And it was delayed to allow time to implement enforcement procedures, but it remains likely that the exemption will be removed. So what this means to the average consumer, the Temu and Shein, which are 30% of the total, and these are your marginal consumers because these are low cost, this fast fashion. If we pull up this graphic here, the cost of removing de minimis here, you found this graphic, Tony. If you want to talk through this is fascinating.
Yeah, I mean, effectively, it's just because you are bypassing the customs processing and the customs broker. It cost, if you ordered something that was $50, it was $50, right? Yeah. Well, now you're going to have a customs broker fee, and then the other processing of that costs money. Like, it's not free to move these things through customs to some degree. It almost doubles. Yeah. And I think that's the challenge. It's like, okay, you are buying something called $10, right? Well, that costs you $20. Yeah. Can you get something very comparable here in the US for $20? Maybe. But I think that's going to be an interesting dynamic is the loophole element of it's fascinating in and of itself. But I think what it does is it's going to impact the marginal consumer. They're going to have to spend more money, whether that's domestically here or to continue to buy these things. It's going to cost more money.
Well, and I think this is such a large...
We've been waiting on the consumer to break to some degree. Is this something that causes...
These are I don't want to call them luxury, but because
discretionary spending.
Discretionary spending, and the argument here, and it's valid, is that you're now pushing your consumer back to purchasing, even though they are largely made in Asia. Yeah, things like Gap, but that have already had tariffs, or they already have that cost kind of built in because their distribution network is based there. So does Temu and Shein now change their logistics and their supply chain to evolve into a place where this de minimis exception is no longer the thing?
Yeah.
Because they were taking advantage of this. And this is a relatively recent growth thing that has happened over the past several years. So it's hard to make that tie to the economy necessarily, but it supports supply chains going back to this Asia to Los Angeles to Chicago to the megalopolis supply chain thing that is the most efficient.
Yeah, for sure. And I think the air cargo part talks story that's on FreightWaves.com talks to that to some degree. Is like it. I mean, it basically who do I think it benefits in the long run? Intermodal companies. One, because
large companies.
Yeah, large
can
companies.
Ship in bulk.
Yeah,
and have big facilities.
Yeah, and they can do it at a cost-effective manner, because at the end of the day, they're still going to try to be the most cost-effective. And for them, where now you're having to go through this, just using air cargo that is typically the most expensive, right? Does it make sense? Like, you can ship something in air now or under the de minimis thing or exemption, and
and
you basically are bypass. I mean, you lose. Yeah, it may not cost you the double in the customs broker. Like it may cost a little more to ship it, but the landed cost is still cheaper than what it would have been. Well, now does that change anything? The dynamics change pretty drastically, where you're still going to have to pay the fees to some degree. Are you going to use the most expensive mode of transit in that case?
No, probably not. And Eric Kulich's article, Air Cargo Industry Jolted by Trump Tariffs on Chinese E-Commerce, is a great piece to read to follow up with this in more detail. But I want to get back to the Mike Bowdendistel article about will ocean rates collapse? The point of the article itself, demand is being pulled forward, ships are being built, and the Red Sea may reopen. All things, except for the demand component, kind of support a downward trend in rates. However, that is, that's not necessarily going to be the case. It should have gone down last year, but there was a point, in the middle of the year last year, I think there was port level disruption in Shanghai, Singapore, that caused some of this inflation. Now, does it necessarily mean that ocean rates should have increased to that scale? Hard to justify, but there's lots of stats in this article that talk about why you really can't lean on a complete collapse in the ocean market. The tariff situation supports continued demand. If we want to pull up the IOTI, this is, of course, we're not far away from where we were at this point last year in terms of total import demand. It looks like things are continuing. Pull forwards are continuing. The tariff threat is going to be ongoing.
That's not going away.
Yeah. But then Stuart Charles writes this article about carriers are not going to rush back to the Red Sea for two reasons. One, the area is still very risky to operate in, and that's a big decision to make. But two, they made a ton of money on not operating in that situation.
Yeah, why? Yeah, the benefit for them is because basically you're adding capacity back to the market. If demand doesn't grow and you add capacity, prices go down. Like it is supply and demand 101.
This is where kind of that, the competitive market doesn't always work in the consumer's favor in the way that money kind of wins some of these short-term decisions. Flexport estimates that the longer routings around the Cape of Good Hope removed 8 to 10% of the capacity. Which I think is a staggering number. That's higher than I expected it to be. And the head of major container line said he doesn't think carriers will restart scheduled services until May at the earliest.
Yeah, because I think one of the things it's already built in to what we're at, over not quite 18 months of kind of avoiding the Red Sea. You're definitely over a year, but I think so supply chains have adapted to longer routings, really it's to Europe, right? Asia to Europe is probably the biggest, the most impacted by this. But I think what it does is if you shorten that transit time and you add in that 8 to 10% capacity on top of the 8+% that we're probably going to see added from the record profits generated in 21 and 22, where ocean container lines are very good at spending money, but they are very bad at where they spend money. They spend money on buying ships. Shocking. But
then they stop sailing them. They blank sail. There's not enough demand.
So you've got the potential for 8% added from shorter transits, 8% added. Just to keep an equilibrium, you would have to see demand grow at relatively, you're talking mid-double digit demand growth. I would be shocked if you saw that. Nothing suggests with where the U.S. economy is, you're going to see that, or the global economy for that matter.
No.
But I think there's the hesitancy, the fact that market share is very constrained or very concentrated on the ocean changes the dynamics. If this was a truckload market, you'd absolutely see rates go down, but you have 90% of the market.
Counterintuitive moves last year with this market in terms of supply and demand economics.
Look at what they did to start the year. They pushed rates up, and it was like demand you were declining ahead of Lunar New Year's pull forward. You were in a soft demand period, and they pushed rates up. They act counterintuitive to what supply demands.
With all the tariffs and everything going off, Global Port Tracker does not expect a major fall off in volume during the first half of the year. But like we mentioned before, Trump has described a 10% as just an opening salvo on terms of tariffs in Asia.
Yep.
So second half of the year, demand is in question, but it's still really, really fuzzy. And I think that's still this uncertainty, this cloudy future makes everyone kind of have to stay on edge.
Well, and that's why you won't see rates go down is uncertainty.
And that is
Because
inflationary.
You won't act in any way. You're going to act in status quo to some degree, because the last thing you want to do is make a big move and then guess wrong, and then it would not be. That's where problems arise.
Yeah, so much for that. Well, everyone have a good Valentine's Day weekend. Go get some flowers.